Hello everybody, welcome back to Capital Code. Today we'll be going over the basics of the types of markets and financial instruments, also known as equities, that guide the entirety of the financial world. First of all, it's important to define what exactly we mean by markets. Economists formally define a market as any setup that allows buyers and sellers to make transactions. Prices are influenced by all buyers and sellers through supply and demand. Markets have a multitude of characteristics, including the asset being traded, the time span of the exchanges, and the size of the markets, such as local, national, or international. Since the separation between markets can be a little amorphous, it can get confusing. However, knowing about different types of markets can be important because each of them has its own benefits and risks. Based on your priorities, you can decide which one best fits your needs. The largest umbrella term for markets is financial markets. It includes all the other types of markets that we will discuss. Before we get into the nitty-gritty of the different types of markets, it's essential to lay down the instruments investors use to interact with markets. What exactly are financial instruments? Financial instruments are monetary contracts between parties that can be bought, sold, changed, or completed. The main ones being bonds, equities, and derivatives, which we'll go over more in detail. Another term that is commonly used to encompass financial instruments is securities. Starting off, what are equities? As previously mentioned, equities are one of the most important financial instruments. They are also the most common among the instruments. Equities are assets that represent ownership of companies, and they exist to align investor incentives with company performance. When investors own shares, they benefit directly from the company's success and suffer from its failure. This shared risk encourages long-term thinking and capital commitment. Equity markets are particularly powerful because they allow companies to raise large sums of money without fixed repayment obligations. Investors accept uncertainty in exchange for unlimited upside potential. This structure is a major driver of innovation and entrepreneurship in modern economies. Next up, bonds. Predictability and priority. Bonds are a debt instrument that essentially represents a loan from the lender to the borrower. Bonds exist because not all investors want uncertainty. They provide predictable income and legal priority in the event of failure. This makes them suitable for conservative investors, institutions, and retirees. By allowing both debt and equity financing, markets accommodate different risk tolerances and financial goals. Some examples of common bonds are treasury bonds, also known as security bonds, which are bonds given by the government which the person can buy and then later be assured they're going to be given back, essentially loans that you give to the government. These can come in three main forms: T-bills, which returns are expected within a year; T-notes, which returns are expected within 2 to 10 years; and T-bonds, where returns are expected within 20 to 30 years. Another example is municipal bonds, which are loans that you give to local governments so that they improve the infrastructure, which gives you interest over time as well. A third example is corporate bonds, which are loans that you give to companies so that they can improve their technology in order to produce more. You work as the lender instead of the partner, unlike in the stock market. Therefore, you take priority over shareholders. Next, derivatives, managing uncertainty. Derivatives are essentially a contract between the buyer and the seller. They commonly possess the following properties. 1. An item, the underlying asset that can be bought or sold. 2. A future transaction which must occur between the short and long sides, such as a sale or purchase of the underlier. 3. A price at which the future transaction must take place. This is also called a strike. 4. A future date by which the act, such as a purchase or a sale, must be done. These are called maturities. 5. Zero-sum gains. Whatever one side gains, the other side loses. Some examples of derivatives are: 1. Forward derivatives. Imagine that you want to sell your jewelry for $1,200 in at most 8 months. You could sign a derivative as your friend as the buyer that ensures you get $1,200 in 8 months. However, if the jewelry company increases the price to $1,400 4 months into the contract, there would be a higher worth of your jewelry. Hence, your friend could sell the derivative to turn a profit of $200, but you wouldn't be able to get more money even though there's an increase in demand. Another type is future derivatives. People liked Fords a lot, therefore people standardized them. There could be 20 Tesla shares by 2026 for $800 each, 10 barrels of oil by February 12th for $212, or even 20 anime pillows by February 19th for $20 each. They just need a buyer and a seller to engage in them. Note: either side can exchange their profit or loss before the maturity date with other traders that are willing, but at the moment of the maturity date, each side has to settle and provide the amount assigned in the contracts. Put options, also known as cancel option. The short side gives a premium to the long side in exchange for a burn option that allows them to cancel the contracts. Call options are the long side gives the premium to the short side in exchange for a burn option that allows them to burn the contracts. Derivatives exist primarily to manage risk, not to gamble. They allow market participants to lock in prices, hedge against unfavorable changes, and stabilize future costs or revenues. A real-life example would be an airplane company buying a derivative for oil right now, so they know for sure they will have an amount of oil on a later date, which is a good example right now because oil's price fluctuates a lot. Although speculation is common today, derivatives were originally tools for economic planning. Their zero-sum nature makes them powerful but dangerous when misunderstood. A key term related to this is IPO. The company has to go through the initial public offering (IPO) in order for a private company to become a public company. This is how a company can provide financial instruments and engage with the larger public. The IPO process is, first, to hire an investment bank which evaluates the value of the shares, and then second, file with the SEC, the Security Exchange Commission, such as Goldman Sachs, and then lastly, go public. Next up, primary markets, where securities are created. Primary markets exist to solve one specific problem: how do companies and governments raise new securities? Which, just to remind, is the umbrella term for all types of financial instruments. Well, the place where new securities are created and traded for the first time. Money goes directly from the investors to the issuer of securities. Therefore, the value of the company/government goes up. This is also why primary markets are typically restricted to professional investors. New securities are riskier because their fair value is not yet established. Institutional investors have the resources to evaluate this uncertainty and absorb potential losses. Some examples are the IPO. This is when a company sells its shares for the very first time. Since it's selling new securities, this counts as primary, bought by institutional investors. Another main type of market is secondary markets. This is the place where older securities are sold. This is where the average Joe thrives, and involves buying securities from other investors that bought shares from the initial public offering required for the company to go public. Step 1. IPO happens and the professional investors, which are usually institutional investors or small-tail retail investors, invest. Number 2, the lockup period, so there isn't an instant surge and the IPO don't get sold out, immediately at least. There's a fixed period of time where there is no activity, in which initial investors can't sell. 3, the stocks are sold, moving from investor to investor. An example of this would be the stock exchange, where stocks get sold from one to another. Brokers and market makers, making markets work. Brokers exist to provide access. Since whenever you buy a stock, you don't buy from the company but another investor. Broker serves the middleman between the seller and the buyer that set up the transaction. In modern markets, this process is automated, but the function remains the same, enabling participation. Market makers exist to ensure continuity. At any given moment, there may not be a natural buyer or seller at the same price. Market makers solve this by always being willing to trade at the quoted prices, profiting from the small difference between buying and selling prices known as the spread. Without market makers, prices would jump erratically and many trades would fail to execute. Their presence keeps markets stable and functional. Underwriting, transparent risk. When an investment bank underwrites an issuance, it agrees to public securities at a predetermined price. The company receives guaranteed funding, while the bank takes responsibility for reselling the securities to investors. The bank profits by selling at a slightly higher price, but it also bears the risk of unsold shares. This process stabilizes capital formation and allows companies to plan confidently. Without underwriting, raising money through public markets would be unpredictable and unreliable. An example of this would be a company with a market cap of $1 billion goes to a bank and requests $1 million in exchange for shares. If the investment bank accepts, the investment bank is going to give them $1 million and is going to try each share slightly higher than the price they bought it for. So if the price for each share bought by the bank is $20, the bank might try and sell it for 21. If the bank is unable to sell each share, they might have to bite the loss. But the upside is they could make a profit. Capital markets funding long-term growth. Capital markets exist to fund long-term economic growth. When a company wants to build a factory, research a new technology, or expand into new countries, it needs large amounts of money that will not always be able to be repaid quickly. Similarly, when governments build infrastructure like highways, power grids, or public transit systems, they require long-term financing. Capital markets allow companies and governments to raise this money by selling long-lived financial instruments such as stocks and long-term bonds. In exchange, investors give up liquidity and accept uncertainty. Because the money is tied up for years or decades, capital markets inherently carry more risk. However, they also offer higher potential returns, which compensates investors for taking that risk. The trade-off between time, risk, and return is fundamental. Capital markets exist because without them, large-scale projects that define modern economics would be nearly impossible to fund. Money markets, stability and short-term liquidity. Money markets exist for the exact opposite reason. Instead of maximizing growth, their purpose is preserving value while maintaining liquidity. Large institutions such as banks, corporations, and governments frequently need a place to temporarily store money without exposing it to price volatility. Money market instruments are short-term by design, often maturing in less than a year. Because the time horizon is so short, uncertainty is reduced. Returns are small, but predictability is high. This makes money markets ideal for managing cash flow rather than building wealth. For example, when a corporation has payroll due in 3 months, it cannot risk investing that money in stocks. Money markets exist to solve this problem by offering a safe place to park capital until it is needed. Some examples of this could be a certificate of deposit, which is when money is locked for a while to earn a fixed interest rate, or T-bills, lending money to the government for a short period of time, usually less than a year, as earlier we noted. Just as a note, capital and money markets is a broad term to generalize the many kinds of investments that occur, and isn't really a rigid definition. When viewed together, financial markets are not about greed or speculation. They're coordination systems that allocate resources, distribute risk, and enable long-term growth in the economy. Understanding their structure lets you move beyond headlines and actually see how money shapes the real world. Thank you for watching Public Markets. We hope you enjoyed, and we hope to see you next time on Capital Code.